Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So summary, trading it easy, all right? But by understanding when not to trade, traders can improve their ability to trade. So learn volatility, learn time, learn skew, all right? Like my dad used to say, the number one way to stay out of trouble is to avoid the situation, okay? Do we have any questions? Can I put the slide that says skew and the butterfly? Yeah, you like iron butterfly? I forgot I'd written that. That's funny. I have to admit, I'm funny, you know? And it's not just my mom that tells me. So does my wife. You get it? That's a line from In the Garden of Eden. All right. Why do you prefer iron butterflies over normal butterflies? It has to do with execution. Okay. So I'm going to share the screen with you again. I'm going to share my screen number 2, and let's just look at FCG. Okay. And if you look at width, all right, of in the money versus out of the money. Okay. And we'll go to June. All right. What do you notice about? Well, this one's actually relatively similar. We went way out though. We'll find it. All right. So if we look at this, the December, if we were going to do the 20, 25, 30, all right, or 29 butterfly. All right, we're going to do the 20, 25, 30. What do you notice? All right, on the 20 strike, the 20 calls are 50 cents wide. The 20 puts are 30 cents wide. On the 25, they're pretty close to about the same. And on the 30s, the 30 puts are 50 cents wide. The 30 calls are about 30 cents wide. So just from an ease and execution standpoint and from a pricing standpoint, the tighter the spread, the easier it is for me to evaluate the price. Okay? What's fair, what's not. Okay? So because of that, I generally prefer iron to regular. Okay? Does anybody else have any questions? In the Garden of Eden, baby. So, you mentioned condors are not good when vol is really high. You said snapback risk. Do you mean directional snapback risk or something related to vol? I mean directional snapback risk, okay? Every time, you'll notice when vol gets really, 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 really high, all right? It's like you're pulling a rubber band, okay, on the market, all right? It gets really high, and then we get that big, big, huge snap. So one of the things I've kind of found is when vol is really, really crazy high, you are in a much safer position selling put spreads than you are selling put spreads, sometimes called credit spreads, than you are in putting on a condor. All right? That call credit spread just doesn't have the right risk-reward to it. Okay? All right. Iron butterfly got him. I didn't understand why you preferred iron butterflies over regular. Please repeat. It has to do with width. Okay, so let me quickly. I'm going to use my my John Madden again, and we're going to pull up a picture of FCG. edit, copy, and I'm going to share my desktop, share to, and paste. All right. Here we go. All right. Now, suppose that I'm setting up an iron butterfly, okay, and I'm going to put on, I'm putting on up type of butterfly, and I'm going to do a 20, 25, 30, okay? What I want you to notice is the width of the market here on the two wings, okay? The wider the market, the more difficult it is for me to price that spread, okay? So here I've got 30 cents of width. Here I've got 50 cents, 30, 50, okay? So I'm going to have a much easier time filling my long on the calls and filling my long on the put. And so because of that, I do the iron. And I just presume the at-the-money is I'm be able to manage. But does that make sense? All right. You said the credit spread was better bet on a high vol environment. Did you mean because of the directional snapback risk, you're better off taking a directional stance with credit spreads than putting on a condor and dealing with the delta risk? That is absolutely correct. That's what I found, generally speaking. When vol is super high, like you said, isn't it more advantageous to sell call spreads than put spreads because the long put will be extremely expensive? Yeah, but the short put's going to be really expensive too. All right. The problem is, and you don't want to sell call spreads unless you're planning on doing some sort of buy right call spread, because you may get that vol help, but that delta will kill you. All right. You asked anybody that traded calls into the flash crash, and they got smoked. Okay. So the real key is being efficient. Okay? All right, and one of the things we found is that, when you hit these really high peaks, all right, when you hit these really major vol spikes, all right, the condor doesn't work. All right, it's generally a losing proposition. All right. Do we have more questions? You said the flat skew is better for butterflies and the steep skew is better for condors. Do you mean you put the trade on and skews need be such, or do you mean the skew needs to maintain the stance throughout? No. Actually, it's interesting. What you want is you actually want to put on a butterfly when skews are flat, and then have skew move in your favor. Okay, let me show you. I'll show you this real fast. Boy, you guys are just getting. Whoop, wrong one. Wrong one. Sorry, folks. I want to look at 2. So let me pull up a real brief painting. So imagine this, all right? You've put a trade on with a skew curve that looks like such, okay? Actually, I should really use my widget. Watch this. This is something that one of my students wrote for me. This is really cool. I haven't used this in a while, so I'm hoping. Come on. Rotate. Come on. Yeah, it's not. He must be working on it. All right. So imagine you throw on a butterfly where you're basically buying here, selling here, and then buying here. All right? Now, what happens is vol goes up a little bit, and that skew kind of works in your favor. Or skew shifts. Well, now let's take a look at what's happened. Your ax didn't move, but your long, what do you think happened here, guys? What is this, when vol shifts and you own an option, what happens to your account? You make money. All right, so let me show you this. This is a, I'm going to show you, all right, so here's the short call, short put, here's the long call, and here's the long put. All right. All right, and now what I'm going to do is I'm going to edit the skew here. And look at how as I steepen that skew, this out of the money put just explodes. Look at the distance it moves. Okay? Watch this. You see this red line? The at-the-monies are on the red line, so are the calls. The put's a little above it. All right? Once I pull, look at how that put gains value. Look at the spread difference. Look at the way that's just absolutely exploded in value. All right. So I generalize and then say, which strategy works better for underlying investment skew and which strategy works better for a commodity skew? You know, it actually has nothing to do with commodity versus investment. It has to do with the steepness of that skew itself. Does that make sense? All right. Somebody said, so would you be selling iron condors 55 to 60 days to expiration? That's generally when I'm looking at them.
All right, let's maybe cover one more question because I think we need to wrap up in just a couple more minutes.
I like to lay it on for these people.
All right, is that it, I guess, for the questions for tonight?
I think so.
Okay, great.
Yeah. Can I generalize which strategy works better? You know, it depends on the steepness of the skew, not on whether it's commodity or investment itself. Okay, that's a very important difference. All right, guys, give me a call. You know, I'd love to, and read my blog. I read every day. You know, a couple of days ago, if you go to my blog, I'm going to show you this real quickly. If you went to my blog, if you had gone to my blog on, they might just be having slow internet here in the building. No, if you go to my blog on Monday, I put up a May SPX skew trade that is absolutely crushing it, and it was just because I was noticing that you got really flat. Okay? And so I write on my blog every day kind of what I think is useful information. And, you know, we do this AM pit report every morning at 8:50. I talk for free for about 10 minutes. You can listen in, 8:50 Central Time. And then, you know, our services are probably the best out there. And, you know, if you're interested in mentoring, give me a call, shoot me an email, check out our website. Because, you know, I'm absolutely the best in the business. So, all right? Any other questions?
All right, looks like that's it, actually.
We're going to wrap up.
All right, great. So let's just cover that final slide. I did want to give people a chance to see some of the ISE resources that are available to them today. So if you,
why am I not?
Are you not seeing that?
It's not letting me click.
No.
Interesting.
All right, well, hopefully everyone else can see it. We're on slide 18 as of right now. So we're just covering some of the resources that are available for free, educational resources that are provided by ISE. So if you do want to learn more about the ETFs that we discussed today, please make sure to visit www.ise.com/ETF. You will be able to find more product info, articles, and a link to sign up for free trade alerts that can help you learn how to best trade the ETFs. These are actually really great for investors who are new to the product. So as you can see, we do have a lot of resources available. So if you're looking to trade products based on these industries and sectors, do make sure to take advantage. If you have any questions or comments, make sure to send an email to webinars@ise.com. And I guess that's it. Our thanks again to Mark for sharing your insights today. Thanks to all of you for joining us and bearing with us through a few of our audio issues this afternoon. And we do hope to see you back next time. Thanks.
All right, sounds good. Thanks.
Thanks, Mark. Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.